In Chapter 10, we will be looking at property acquisition and cost recovery. For the most part, depreciation calculation, which is cost recovery, has not changed the base way of calculating it. However, there are some new expensing options and revised expensing options that we'll be looking at that did come about with the new tax law change. We're going to explain the concepts of basis and adjusted basis and describe the cost recovery methods used under tax law to recover the cost of personal property, real property, intangible assets. We're not going to cover natural resources in this presentation. Determine the applicable cost recovery or depreciation life, method, and convention for tangible personal and real property, and calculate the deduction allowed under the basic system called MACRS. Explain the additional special cost recovery of 179 bonus listed property and calculate the deduction allowable under these rules. And then explain the rationale behind amortization and the 4 categories of amortizable intangible assets and calculate it. As I said, we're not covering Objective 5. So we're focusing on businesses here and real estate, rental real estate. Businesses must capitalize the cost of assets with a useful life of more than 1 year. So if you buy something, you're going to use it more than 1 year, we must capitalize it. Then we recover the cost of that asset, meaning we expense that cost over the time limit we're going to use it. Depreciation is what we call the expensing of tangible assets. Amortization is what we call the expensing of intangible assets. And there is depletion, which is the expensing of natural resources. Businesses use these methods to recover the cost of the assets they paid for due to wear and tear and obsolescence of the assets. So we're not allowed to deduct the expenditure for these assets, as we saw in Chapter 9, the year we buy them. But we are allowed to deduct an allocated amount of that cost each year as we use them. As I said, depreciation is when we expense the cost of tangible personal and real property. Let's clear up any misconception right now. What is personal property? It is not assets you use personally. Okay? And this is the word that they use to describe non-real estate property in business. So non-real estate, equipment, vehicles, machinery, furniture, vehicles. So everything that you use that's a tangible asset you're going to use more than a year that is not a building or land, basically. Real property then is real estate. This is your buildings, whether it's a commercial building, an apartment building, a warehouse, a garage, any kind of real estate. Amortization is what we use to describe expensing or deducting the cost of intangible property. And then, of course, depletion. So make sure you understand what we're talking about here. It's not personal use property, it's personal property. And that's, I know it's a silly word. I almost said stupid, right? But it is a word that's used to describe something that we do use personally, but that's not what it means here. Now, let's talk cost recovery as far as what do we get to deduct. Basis for cost recovery is what we call that. Once the use of purchased assets is started, now you can start recouping the cost of the assets or calculating depreciation for tangible assets. Cost basis reduces when cost is recovered through cost recovery deduction. So remember when we're selling an asset, we use the asset's adjusted or tax basis. So an asset's adjusted basis will be how much you initially paid for it, plus improvements, minus the total depreciation or amortization you've taken. So you've got to keep that in mind, and we're just bringing this out to you. That's what adjusted basis is. It's more than just what you pay for it in a business. You add any improvements you made to it that will last more than a year and subtract all depreciation taken on the asset and the improvements. Take a look. Scrap Happy, a scrapbooking retail chain, purchased an old office building for $175,000 for use in expanding its current operations. It spent an additional $15,000 painting and remodeling the building to prepare it for its opening. There's the first scenario. 2 years later, an employee discovered that several leaks in the roof were causing serious water damage, and the company spent $50,000 to re-roof the entire building. Every 6 months, Scrap Happy pays $500 to have the carpet professionally cleaned. So let's take a look and see how Scrap Happy handles these. I think. There we go. What is the original basis of the building? What effect do the other two transactions have on the original basis? Well, the initial cost was $175,000. And by the way, it doesn't matter if you're buying a new or a used, previously used item to calculate cost recovery. So even though this is a, quote, used building, they paid $175,000. The additional painting and remodeling to get it ready for its first use added to the cost of the building. And that's the original basis. That's the, quote, total cost. The $50,000 re-roofing expense is added to the basis as an improvement. This results in a restoration of a major component of the building. So any expenditures after you start using that will last for more than a year, they are capitalized as well, and this will be depreciated. The biannual carpet cleaning is a routine maintenance to keep the rugs clean. That will be immediately expensed. That is not added to basis. Okay, again, personal assets. Make sure we understand that. Personal property is comprised of tangible assets, automobiles, equipment and machinery, furniture, any other vehicle. Real property is buildings and land. Intangibles are non-physical assets. We know that from our prior course work. They're an asset that's basically invisible, does not have physical substance. And then natural resources are commodities that are considered valuable in their natural form. Oil, coal, timber, and gold, just so you're familiar with that. And there's the cost recovery we perform under each type. So we're going to start with personal and real property. Before 1981, tax depreciation methods closely resembled financial accounting methods. So it's basically pick one of those, do what you want. There was no official tax system. But in 1981, Congress introduced a tax depreciation system called accelerated cost recovery. Most assets under that system have fully depreciated, so we will not be learning that. In 1986, after the major tax code recodification under Reagan, and someone was taking tax accounting at that time, a new system was introduced, and I learned both when I was taking tax. Talk about confusing, but it's called Modified Accelerated Cost Recovery System, and that is our staple system now. That is what we're currently using to depreciate tangible properties. And we pronounce it MACRS, and they even put the little quote there so you understand. The acronym is MACRS, and we say MACRS. To compute MACRS depreciation for an asset, the following needs to be known: the original cost, what type of depreciation method you're going to use, because you actually have two to choose from. How long is the asset's life? And different from financial accounting, we don't get to decide the asset's life based on how long we plan on using it in our business. It's actually defined in the tax code. So you'll be told the life of the asset depending on what you purchase. And then the applicable depreciation convention that we'll discuss determining with the personal property, we use what's called half-year convention or mid-quarter convention, and then real property, your buildings, mid-month. So we'll talk about what that means. So personal property depreciation is our first area. Includes all tangible property such as computers, vehicles, furniture, machinery, equipment, other than real estate, real property. Personal property, not real property, and personal use property are not the same. So there we pointed out to you. Be careful of that. So these are personal property assets from our first bullet point that are used in a business. They are not personal use. If the assets are used by you personally, not in your business, it'll say personal use. So that's how we keep the two separated in taxes. Under MACRS, you actually have a choice of 3 acceptable methods for depreciating these types of assets: 200% double declining balance, 150% declining balance. And I could tell you, based on the life of the asset, the type of asset, it will be either of those two. The other method is straight line. So if you don't want to use an accelerated method of depreciation, if you want to spread out that cost evenly, basically, you can use straight line for personal property. We're not really going to deal with straight line because most people use 200% declining balance. For financial accounting purposes, an asset's recovery life is based on what the company feels. That's what the first bullet says. But for tax purposes, the cost recovery or the life is predetermined by the IRS. And actually, Revenue Procedure 8756, 1987, which helps taxpayers categorize each of their assets based upon the property's description. I am not going to make you look at that. It's very lengthy. And of course it would be, because they're trying to guide you on every type of possible asset that could be purchased. We are going to focus on a few, and we'll define that in a second. Once the business has determined the appropriate categories for its assets, it can use the revenue procedure to identify the recovery period. For instance, here's office furniture. This is a little part of Revenue Procedure 8756. It's the middle column that we focus on. So once office furniture, fixtures, and equipment, and it gets very specific, this includes items that are not a structural component of a building: desks, files, safes, communication equipment. Does not include communication equipment, though, included in other classes. So some communication equipment could be 5-year, but it's 7-year, a 7-year life, and that's one of the common categories we'll be dealing with. The other is the 5-year category. Look at here, light general purpose trucks includes trucks for use over the road. What we're talking about here is basically every truck but a tractor of a tractor trailer. Tractor trailers are 3-year property. So what are our common cost recovery periods available? Well, we're going to see a table in a few minutes, and we'll see all the different ones. But some lives are for very, like I say, exotic or extraordinary types of assets. Most companies don't have them. The two major recovery periods are listed right in front of you, the 5-year and the 7-year. So the 5-year is where that's the life of our cars, our light general purpose trucks, including our dump trucks, computers, and the computer's peripheral equipment, printers, routers, databases, database storage, whatever. I don't know all that stuff myself, but any kind of costs associated with those would be considered 5-year property. That's the recovery period. Office furniture, fixtures, equipment, machinery, all of those things are 7-year. Okay, so those two lives are the most heavily used when depreciating business assets because most of them fall within those two lives. Once we determine the life of the asset, now we have to determine what we call the convention. Half-year convention. What the IRS does is they don't allow us to calculate using formulas the depreciation. They create tables of percentages and say, take the cost of your asset times the amount you find on that table, and that's how much depreciation you get. So they have to create these tables with some assumptions because are they going to give you a full year's depreciation the first year? Well, normally when we calculate depreciation in the first year, we say, how long did we own the asset during the year? If we only owned it 3 months, normally we only get to take 3 months of depreciation. Well, to correct or to try to find a common ground, the IRS said, we're going to assume under this half-year convention tables that we create that all assets in the first year were purchased halfway through the year. So if you're a calendar year taxpayer, no matter when you bought that asset during the year, you can take a half a year's depreciation on it. And that's what the tables are already set up to do. Calculate 6 months worth of depreciation. Even though you may only owned it 2 months or 4 months or 12 months, you only get a half a year in the first year. Then you get your 12 months, 12 months, 12 months, 12 months, depending on the life of the asset. And then you'll go into the final tax year with another 6 months depreciation. If an asset is disposed of before it's fully depreciated, you've used all the percentages, you've sold it before its life is up. In the final year, when you sell it that year, you get a half a year's depreciation only. So even if you sell it December 1st of that year, you get a half a year's in the year of disposition. Now, if you buy it and sell it in the same year, no depreciation. Now think about this. You are allowed to take a full 6 months of depreciation, no matter when you buy an asset during the year. Right? Now, you start looking for some loopholes with that, and you think to yourself, when should I buy my assets? Well, if you're savvy and you can wait, you'll probably wait till December of each year to buy the assets. Why? You'll get a month of use out of them, but 6 months of depreciation. To stop that from occurring, to stop companies from buying everything in that latter part of the year, Congress came up with what's called the mid-quarter convention. And here's what it says. Add up all the basis of all tangible personal property, whether new or used, for the entire year. Only tangible personal property, not real estate. You don't include that in this calculation. In the second step, you add up all of the same personal property you purchased, but only the ones you purchased in the fourth quarter. So that would be, if you're a calendar year, October, November, and December. Divide the total into the amount you purchased in the fourth quarter. If if the answer is more than 40%, you cannot use half-year convention to depreciate the assets. You use what's called a mid-quarter convention. So if you buy more than 40% of your personal assets in that last quarter, you're not going to be able to take advantage of a full half years of depreciation. Instead, you're going to use the mid-quarter convention. And here's what that says. There are 4 quarters in a year. Okay? No, and this applies, by the way. If this calculation for a year, and you do this calculation every year, if you are forced into a mid-quarter convention, all the assets, personal assets purchased that year, use mid-quarter convention. So we have to calculate now using 4 different tables. One for purchases in the first quarter, one for purchases in the second quarter, one for purchases in the third quarter, and one for purchases in the fourth quarter. And we'll be seeing those tables in a few minutes. The assumption with this is that you purchase an asset in the middle of the quarter that you originally bought it. So let's say you buy, you have your company for 2017 has to apply mid-quarter convention. You purchased an asset on July 15th. So what we do is we say, okay, what quarter was that purchased in? Well, the first quarter would be January, February, March, then April, May, and June, July. So that's the third quarter. We would use a table that's set up for third quarter purchases. But how that table is designed is it says you will get a full fourth quarter depreciation. So you're going to get to calculate depreciation for October, November, and December. But because you bought this in the third quarter, you're only going to get a half a quarter of depreciation for the third quarter. We ignored January through June. There was no depreciation there. So the assumption is you bought it in the middle of the quarter. You're going to get a half a quarter of depreciation, so a month and a half, and then the 3 months at the end. And that's how it is set up. So, calculating depreciation for personal use assets. First, we have to find the life of the, first find the basis. Then find the life of the asset using that revenue procedure 8757. But as I said, it's usually going to be a 5-year life or a 7-year life. Then we're going to see in a second the tables. We select the column that corresponds with the asset's cost recovery. Once we find a table for an asset and a column, we use that same table and column to calculate depreciation for the remaining life of that asset. We never switch to another table. We find the row identifying the year of the asset's recovery period. So what year are we calculating depreciation for? Is it the first year of the life, second, third, etc.? We have to make sure we select the correct table because it could be half year or mid-quarter. And remember, when we're disposing of an asset in the year of disposition, if we used a half-year table, we only get a half a year's depreciation that year. If we used a mid-quarter table, we only get, we have to apply the mid-quarter convention for the year of disposition as well. So there's our table for half-year convention. As you can see, there are many different lives up here, but 3-year. The only thing I've ever depreciating using the 3-year column is a tractor from a tractor trailer. And I worked at a trucking company. Okay, so that's pretty industry specific. But the 5-year assets are across all industries, vehicles, computers, the peripheral equipment. 7-year is your most use and the most activity happens there. Machinery, equipment, furniture. 10-year, I'm not even sure. I think there's tugboats and water vessels. I mean, it's such a unique category. It's for specialized industries. 15 years, so you know, is for land improvements. So we're looking at fencing here. So that could be a common one. fencing, sprinkler systems, sidewalks, parking lots, anything under that land improvement are generally in that 15-year category. And 20-year, I've never used, I'm not even sure. I remember horticultural structures. I mean, really? So keep in mind there are other lives out there, but it's generally that 5 and 7 year life that you're going to use. Now, if you've determined your assets can be depreciated using half year, this is your table. So you always want to make sure you could reference back to this table. Once you start using it a while, you start memorizing some of the numbers, as I have for 30 years of use. Because remember, this came out when I was in college, so I've been using this 30 years now. Here's your mid-quarter. Remember I said there's various tables. Now, they put all the tables here for the first quarter. As you can see, if it's a 5-year asset or a 7-year asset, the second quarter purchases, 5-year, 7-year, the third quarter, 5-year, 7-year, and the fourth quarter, 5-year, 7-year. Okay, so you will use the quarter of the assets purchase to calculate depreciation when it comes to this. So let me do a real quick example with you, and you have to grab a piece of paper. It's not on our PowerPoint. So let's say we purchase 2 assets. Okay, jot this down. The first asset will be my dump trucks. A dump truck for $40,000, and we need to know when we purchased that. So let's say we bought it on 3/1/17. Okay, and the other will be furniture, and that will be for $70,000, and we're going to make that one on 6/1/17. Okay. Now, the first thing we want to do is determine the life of the asset. So we say, is the dump truck a 5-year, 3-year, 7-year? What life? Well, we already talked about this, but vehicles are generally 5 years. So you want to jot that down. Furniture, we already know and we've seen, is a 7-year. So we've defined their cost recovery. We know what column we're going to use. Now we got to figure out what table to use. So we ask ourselves, are any of these assets we bought this year, and assume these are the only 2 assets purchased, personal assets, are any of them bought in the fourth quarter? And the answer is no. So 0% of our personal assets are purchased in the fourth quarter. So there's no mid-quarter convention. Now I know I'm on the mid-quarter tables, so you're going to have to flash back or check in your book for the percentages we're about to use. I memorize them. Since we don't have to use mid-quarter, we're going to use half year. So I'm just going to write an HY next to my amount. So I know I use the half year table. Now for my dump truck, I'm going to use the 5-year column. So I'm going to go to my half year convention table. First you have your 3-year column. Then you want to go to your 5-year column. You want to go to your all the way on the left, the year. It's first year cost recovery. So it's kind of like using, it's a table. You got to use your column and your row, and where they intersect, that's the percentage you will use. So you can see for a 5-year asset, first year, 20% is the amount you use to calculate depreciation. So dump truck would be $40,000 times 20%, $8,000 of depreciation in year 1. For the furniture, you do the same process. Go to the 7-year column, first year cost recovery, $70,000 times 14.29%, and 70,000 times 0.1429. 14.29% would be $10,003. So that's how you use that table. Next year, when you go to record depreciation for the dump truck, you'll go to your 5-year column again, but now use year 2 row. So you would use 32%. The furniture, you would do the same thing, but go to the 7-year column, year 2, 24.49%. Remember what I said, once your asset has a table and a column, you use that table and column each year. You're just going to go down to the next percentage because it's the next year of cost recovery. Okay, let's just change our example a little bit. Let's say the furniture was purchased on 11.1. 11.1 instead. 11.1. We know the lives of the asset, but now we ask ourselves, was any of the assets purchased in the fourth quarter? Yes. The furniture. So we have to do our calculation. Remember, we take purchases of personal assets in the fourth quarter. That's in our numerator. So it would be 70,000. Divide that by all personal assets purchased for the year, and that would be 110,000. We're trying to determine if more than 40% of our personal assets are purchased in the fourth quarter, and they are, but let's just, to humor ourselves, take the 70,000 in assets purchased in the fourth quarter divided by the total assets, personal assets purchased in the year, and of 110,000, so 64%. So more than 40% of the assets were purchased in the fourth quarter. That makes us use mid-quarter convention for all assets purchased this year. So how will we calculate the dump trucks? Well, the first thing we ask ourselves is, when was the dump truck purchased? Well, it was purchased on March 1st, so that's the fourth quarter. So the dump truck will use the first quarter 5-year column. So we'll take 40,000, and you could see that one right in front of you, times 35%, or $14,000. And it will always use that column and table. The furniture, which is a 7-year asset, was purchased in the fourth quarter. So we're going to go all the way to the opposite side of our PowerPoint here. Last column, 7 years. First year cost recovery for assets purchased in the fourth quarter. 3.57% is the percentage we multiply the cost by. 0.0357, and I'm getting $24.99. So you can see here that the depreciation is dramatically different between half year and mid-quarter convention. There was something I want to say. Oh, and one thing you got to remember, each year we take the cost, or that basis we determined back in the beginning of the slides, and that's the amount we use to determine depreciation every single year. That amount times the new percentage. One other thing we didn't talk about, and I don't know if you noticed or not, there's no use of salvage values here. Nope, no salvage value. It's ignored when we're calculating MACRS depreciation. Okay, so that's just showing you how they come up with those percentages. As I said, in the first quarter, 1.5 months. This is for disposition. I'm sorry. If you sell an asset, remember what we said. If you sell an asset under half-year convention in the year of disposition, in the year of sale, you calculate depreciation using the percentage on the table. But after the first year, that percentage represents a whole year's worth of depreciation. So you're only allowed to take 6 months of it. So you multiply that result by 50% to get that year's depreciation. What if you're using a mid-quarter convention? Well, the same rule applies. In the first year, it's assumed you bought it in the middle of the quarter. But after that, each year's percentage, except for the final year, but each year's percentage is assuming a 12-month use. So you get a full year's calculation there. Well, if you sell an asset in the first quarter, you're only allowed to take 1.5 quarters worth of depreciation. So that would be 1.5, or 1.5 months, I should say, 1.5 month divided by 12. So you break down that yearly depreciation into months and only take 1.5 months of it for a half a quarter. If you sell the asset in the second quarter, you get 3 months and 1.5 months. If you sell it in the third quarter, you get 2 quarters, which is 6 months and 1.5 months. That's where the 7.5. And if you sell it in the fourth quarter, you get 10.5 months of depreciation. So this is what you use when you are selling an asset. They use the mid-quarter convention. How you calculate depreciation in the year of disposition. Remember, if you buy it and sell it in the first year, there's no depreciation at all. So you don't have to worry about it. So let's take a look at an example. In 2018, Scrap Happy purchased and placed in service the following assets: a die cut machine for $3,500 purchased in the first quarter, and a computer purchased in the fourth quarter for $1,200. The recovery period for each of the assets: the computer is a 5-year recovery, the die cut machine a 7-year recovery. Which convention should Scrap Happy use to determine depreciation? Well, we need to test to see how much of the personal assets were purchased in 2018 in the fourth quarter. So 1,200 of them were purchased in the fourth quarter. The total amount of personal tangible assets purchased for the year are 4,700. Now be careful, if there was any real estate in here that were purchased, you wouldn't include that in your calculation. So since only 25.53% were purchased in the fourth quarter, that's less than the 40%, the company will use half-year convention, which is your table 1. Now assume all the same facts, except that the computer was purchased in February and the machine in October. You go about doing the calculation the same way. Now the die cut machine purchased on October 25th was $3,500. So that's the amount of the assets purchased in the fourth quarter. Total assets, personal assets, were $4,700. So almost 75% of the assets, personal assets purchased were purchased in the fourth quarter. Cannot use half-year convention. You must use a mid-quarter convention. And you see those tables at the end of your chapter. Remember, once you pick a table and a column, you stick with that table and that column for the whole life of the asset. So you would use the fourth quarter table 2D to calculate the die cut machine's depreciation. The computer, you would use the first quarter table 2A to calculate that. And you could see there's the percentages. And please make sure you can find those percentages on the table. If you have any kind of questions, let me know. So that is personal property and MACRS depreciation. Real property MACRS uses mid-month convention and straight line depreciation, and there's only a few lives to choose from. If it's a residential rental, and that's what it should say there, residential rental, 27.5 years. Non-residential property placed in service on or after May 13th, 1993, 39 years, and that's all we're going to worry about. There is another life of non-residential property placed in service before 93 of 31.5 years, but we won't encounter any of that. We're going to focus on 27.5 years and 39 years. On July 12th, Scrap Happy purchases and places in service a warehouse and the land it resides on for $170. $120 is allocated to the building. What is the amount of depreciation on the property for the first year? You only use the $120,000 in your calculation. The land is not depreciated. Please remember that. You go to your table for a 39-year asset. The asset was purchased in July, which is the 7th month. So you will use the 7-month, the 7 column, to calculate all depreciation on that. So in the first year, you get 1.177% of the basis, or $1,412. Who's here? Pat? So what we just reviewed was the normal, straightforward way, and really the ongoing way we calculate depreciation on excuse me, on assets. There are some other special ways that you can expense assets that are normally depreciated. And the first is called Section 179 because that is the code section where it is defined that you can do this. There are limits on expensing. We will look at those. And we have to choose the assets to immediately expense. What assets qualify? There's also another immediate expensing, and that's called bonus depreciation, and that was introduced probably about 10 or 15 years ago. Section 179 expensing has been around for a very long time, 30, 40 years. So let's look at Section 179. Section 179 says basically you can expense personal tangible assets, but there are that you purchase. Let me make sure we write that down. That you purchase during the year. Personal, tangible for the most part. Okay, certain qualified real estate has been included in this definition. Make sure you read through that in your book. I have my book right here. I think I had it in front of me, so let me find it for you so you can read those. Chapter 10. Okay, and that is on the top of page 10-22. No, that's the wrong one. Sorry, that's for bonus. Okay. We're going to look at some of these examples anyway. On page 10-17 is where we're going to be seeing this. If you just bear with me a second, I should have had this ready to tell you where it is. Okay, it's in the middle of the page in the immediate expensing 179 paragraph, about halfway down. It says, however, under Section 179, businesses may elect to immediately expense up to $1 million of tangible personal property. Businesses can also use immediate expensing for off-the-shelf computer software and qualified real property, which is defined down in your footnote. Improvements to non-residential real property placed in service after the date the building was placed in service, including roofs, heating, ventilation, and air conditioning, fire protection, and alarm and security systems. So those kind of improvements on real estate, on non-residential real estate, are allowed to be immediately expensed now, where in the past they weren't. So let's look at this in more detail, because the slides here, they're pre-made by the publisher, of course, and some of them, one or two of them I threw in here, but I want to look at some examples. So we get to immediately expense new and used purchased tangible personal property and some qualifying real estate. The limit, we could expense up to $1 million that we purchase in a year. However, we may not be able to expense it all, so we wouldn't be able to claim Section 179 if it creates a loss in the business. Also, so you know, Section 179, you can pick and choose what assets you would like to expense. You don't have to expense $1 million in the assets that qualify. You can choose. You don't have to expense any of them. It's an optional item. Here's where you're limited to that with that $1 million. If you purchase more than $2.5 million of tangible personal property in a year, for every dollar purchased above $2.5 million, you phase out or reduce your $1 million limit by $1. So if you go to page 10-18, let's find one for you here. Bottom of the page. Example 10-12. Let's assume during 2018, Teton placed into service $2,400,000 in machinery, $920,000 in computers, and an $80,000 delivery truck for a total of $3,400,000 in personal property for the year. What is the maximum Section 179? Well, they purchased more than $2.5 million worth of personal tangible property. So let's see how much more than $2.5 million. $900,000. So they must reduce that $1 million maximum Section 179 they can take by $900,000. So they can only expense up to $100,000 of assets in 2018. Sorry if my microphone is messing up. So once they purchase $3.5 million, they're not eligible for Section 179 expensing. Remember also, you cannot create a loss in the business. And you could take a look at example 10-13 to see how Section 179 would be limited due to income. On page 10-18, here's just a normal example. Let's go to 10-17 actually. Teton is eligible for and elects to immediately deduct $800,000 of Section 179 expense of the assets they purchased in Exhibit 10-8. And they're going to immediately expense $800,000 of the machinery they bought on August 15th. Now, remember, they are eligible for the full million, but that's what they chose to do. So the machinery cost $1.2 million. They're going to immediately expense $800,000. So they can deduct that on their tax return, $800,000. Deduct it right from business income. Here's what else they can do. They still have $400,000 of the cost of the machinery that can be depreciated. So we determine, can they use the half-year table or the mid-quarter table, and what is the life of the machinery? It's a 7-year life, and they could use half-year based on those purchases. So you can also calculate normal MACRS depreciation the same year on the remaining basis. Whenever you expense an asset, you subtract the amount of the expense from the cost. And if there's anything remaining, you can still depreciate that. But now you have to depreciate it under normal MACRS. Also, Section 179 only applies to purchases in that tax year. You can't go back and expense stuff from prior years. So take a look through those examples and let me know if you have any questions. That is how Section 179 works. And like I said, for many years, this was the only available item to expense assets when you bought them. But in the past couple of years, to stimulate the economy, policymakers implement bonus depreciation. Again, qualified assets can be immediately expensed. What you need to know is that bonus depreciation is mandatory. So you must use it, and you must use it for all the assets, or you can opt out of it for all the assets. So, but you must opt out of it. You can't just say, I don't feel like doing it this year. You've got to let the IRS know. If you don't opt out of it, you are to expense immediately personal, tangible property that has less than a 20-year life that you purchased this year, 2018, new or used. And these rules apply through 2022. In the middle of page 10-21, you can see that over the years, we've had, or from this year, we started 100%, but going forward, that amount will decrease. So you will only be able to expense a portion of those items. So if, there's no business income limitation. There's no, you purchased too many assets this year limitation. So if you go to page 10-22, example 1015, assume Teton claims bonus depreciation for their eligible personal property. Remember, real estate does not apply here. Just the items up above. There's your qualified property. And it must be purchased. So a personal asset conversion doesn't apply here. That's what number 1 is talking about there. Assume Teton claims bonus depreciation. So there's their computers, their delivery truck, and their machinery. Okay. Now, they qualify. Steve used this truck and he converted it to business use. Well, that one doesn't qualify. So the $920,000 and the $1.2 million are the two that qualify. He elects to take 100% bonus depreciation. That is his deduction on his tax return. Okay. If he elects out of bonus depreciation and instead says, I just want to use Section 179 and depreciate my assets normally, he would take $1 million in expense for Section 179, have $1.2 million left to, or I'm sorry, let me back up there. That's not what this example is showing. He's going to use bonus depreciation and Section 179. The rules say you use Section 179 first, and then you use bonus depreciation. It's the same results in this case. He'll get a total of, I'm sorry, no, it's not. That's right. The delivery truck. Okay, I messed up something there with Section 179. It normally I believed would be the property wouldn't be included. I'm going to check on that, but 2.2 million are the amount of personal property he put into service. $1 million of Section 179 can be taken, and then he could bonus the remaining 1.2 million. Okay, so take a good look through those examples. Let me just check on something. I don't know if I agree with that. Placed in service. I would like to check on that for Section 179. What it's saying is that if you convert it's allowing it. I just want to double check on that if you convert, sorry, I keep saying it, if you convert an asset from personal to business use, it is allowed to be expensed. I was under the impression it wasn't. Something might have changed there. So I'll post an answer out on email or the announcements about that. I apologize for that. Some of this stuff is really new to, even to me because it just changed. So bonus depreciation, definitely you cannot bonus things that are assets that are personally converted from personal use to business use. Section 179, the jury's still out. Let me get you an answer on that. And it's not saying it directly in the book. I got to go to the tax law. Okay, so bonus depreciation, Section 179. The final area of special weird things that happen with depreciation in taxes is some assets are what we call listed property. It's just a label put on them. All it means is that these are assets that are typically used in business and may have a business and personal use component to them. Things like cars, computers, phones. Okay, so what a business must do is if they are available and used for personal purposes, determine the percentage of personal use and business use. If the asset is used more than 50% in business, you can calculate depreciation normally, but you can only take the percentage used for business. So if you calculate $3,000 in depreciation, well, you can take all $3,000 if it's 100% business use. But if it's only 70% business use, you're only allowed to take $2,100 or 70% of the $3,000. If the business use for this type of asset goes below or equal to 50%, you must use straight line depreciation to calculate depreciation expense for these assets. It will never, even if your asset use goes, the business use of the asset goes above 50% in a future year, once it dips below or equal to 50%, you still use straight line to calculate the depreciation on that asset. So take a quick look on page 10-24. Assume that in addition to the assets Teton purchased, it also purchased a new digital camera for $2,000 that its employees are used for business on weekdays. On weekends, Steve uses it for his photography hobby. Since the camera is listed property, personal/business property, Teton must assess the business use percentage. Teton's determined that 75% business use, 25% personal. So we're going to calculate depreciation normal, MACRS. We're not opting for bonus depreciation or Section 179. So since the business use is above 50%, this is a 5-year asset, assuming half-year convention, 20% is the depreciation rate on it for the first year. So if this was used 100% business, $400 would be the deduction. But since it's only used 75%, $300. Go to page 10-25. Now it's year 2. And Teton's business use percentage goes below 50%. It goes to 40%. Watch what happens. Calculate straight line depreciation for year 2. $2,000 divided by 5 times 40%. So the most depreciation is 160. 160. If they would have taken straight line last year, because that's what you have to do, what would we have taken last year if we had straight line? 2,000 divided by 5 times 50%, because it's a half-year convention the first year. So no matter if you use straight line or double declining balance, the normal MACRS table, you only get a half year's depreciation. 75% business use. So you would have been able to take $150. How much did you take last year? $300. So you took $150 more than you should have. So this year you only get to take $10. $160 minus the amount you took above what you should have if you had used straight line, $10. So take a look at the other example there. That's what happens when we dip below 50% or at 50% for business use. The final slide on the listed property area goes through the steps that we just looked at in that example. If business use drops to 50 or below, use the following calculations. And those are the 4 steps we just talked about. So once again, go through the examples. If you have any questions, let me know. Another area of limitation is for luxury automobiles. If the vehicle is less than 6,000 pounds gross vehicle weight, these limitations apply. So on page 10-26 are the tables for each year. In 2018, if you purchase a vehicle, the first year, your MACRS maximum deduction is $10,000. So if you buy a vehicle for $55,000 and its gross vehicle weight is less than 6,000 pounds, and you can use half-year convention. It's a 5-year asset. You would take 55,000 times 20%. That gives you $11,000 of depreciation, assuming you use 100% business. Well, this limitation only allows you to deduct $10,000 in year one of that calculation. You don't carry over the $1,000. It's just not depreciated yet. It wouldn't be basically subtracted from the basis. So you would have $10,000 of depreciation. Next year, use your $55,000 times 32%. You get $17,600. Well, the maximum amount for year two, $16,000. So you only get to deduct that much of the calculation. And they show you an example in your book comparing a Honda Civic to a Porsche 911. Okay. Now the other complexity here comes in when we buy an auto in 2018 and we're forced to take bonus depreciation. Okay. So you're only allowed to take up to an additional $8,000 in expense. So if your vehicle cost $18,000 or less and it's 100% business use, bonus depreciation is the way to go. But what if your vehicle is more than that? So you want to take a look at the example on pages 1028 and 1029 to get a good understanding of how bonus depreciation and being actually mandatory to take it will affect your depreciation calculation on a luxury automobile. Luxury automobile, new or used, less than 6,000 pounds gross vehicle weight. The next area covers intangible assets and their expensing, and we call that amortization. Businesses can expense or recover the cost of intangible assets through this amortization, which is just the expensing of intangible assets. Intangible assets in the form of capitalized expenditures, such as capitalized research and experimentation or covenants, do not have physical characteristics, patents, copyrights, trademarks, etc. An intangible asset can be placed in one of four general categories. So the first one would be Section 179 intangibles. And there's a discussion about those kind of intangibles on page 10-32. Covenants not to compete, customer list, patents, trademarks. The majority of your intangibles are in this category. There's also startup expenditures and organizational costs. So costs incurred to form and organize a business in the form of a corporation or partnership. There's lawyer fees and other types of costs. Organizational expenditures will include then your meetings, state fees, accounting services, legal services, taking minutes at the meetings. Okay, so these are costs incurred prior to starting the business. And then patents and copyrights. Okay, and they're discussed on page 10-36. And the manner in which a business amortizes or expenses these items depends if they directly purchased them or created them. Section 197, those assets have a recovery period of 15 years, regardless of how long their actual life is. So you will expense them or deduct them over 15 years. A full month convention allows taxpayers to deduct an entire month's worth of amortization for the month of purchase and all subsequent months, and you use straight line, no salvage value. Very straightforward. Organizational expenditures and startup costs include expenditures to form and organize a business in the form of a corporation or a partnership and are incurred prior to the starting of the business. Startup costs are costs businesses incur to start up a business. Research and experimentation. To stay competitive, businesses often invest in activities which will generate innovative products or significantly improve their current products. They immediately expense these costs, or they may elect to capitalize and amortize these over 60 months or less. Beginning in the month, benefits are first derived from the research. So they could either expense them or capitalize them and expense them or deduct them over a time period of no more than 60 months. Patents and copyrights. The manner of amortization depends on whether the business directly purchases this or whether it's self-created. Businesses directly purchasing the patent or copyright amortize the cost over the remaining life of the patent or copyright. Businesses receiving self-created patents or copyrights amortize the cost or basis over the shorter of the legal life or the remaining useful life. So it all depends. Okay, and there's a table to summarize how we amortize different intangibles. So it's very straightforward. It's all straight line. You get a full month, even if you purchase or benefit purchase it in the middle of the month. So one more time, 197 are things like goodwill, trademarks, patents and covenants not to compete. Organizational expenditures and startup costs are capitalized and expensed over 180 months as amortization. Research and experimentation costs are either immediately expensed or deducted over 60 months or less. Self-created patents and copyrights, self-created, are actual life. That's how they're expensed. Purchased patents and copyrights, the remaining life is the life of or the time period that would be used for expensing. Okay, so it's a long one, but we are finally done with Chapter 10 on cost recovery. Please post any questions you may have.